Hello and welcome to part 2 of how to create your own index. In today's video, I'm going to be going through an actual index that I'm making for myself. If you haven't seen the kind of reasons or philosophy behind this, you can watch the first part of the video, the part 1 of this series. I'll put a link to that in the description down below. In today's video, we're going to be actually digging into the individual stocks that I'm going to be buying as a part of my own custom index. Before we get started, I want to remind you that this video is for educational purposes only. It is not investment advice. It is not an offer or solicitation to buy or sell any security. Investing involves risk. You can lose money. Do your own research and consult a licensed professional before acting. I may hold positions in companies discussed today. Positions may change without notice. Opinions are my own. Data are believed, reliable, but not guaranteed. See the video description for the full disclosure. This is the rules that I had. I'm calling it Nathan's S&P 500 Consistent Compounder 30 Coffee Can Index. So I'm starting with the S&P 500 index, and then I'm going to use my research platform, coffeecaninvesting.app, and I'm going to filter only the stocks that earn a 5-star quality score. I'll show you how that's calculated. Then I'm going to rank them all by best to worst estimated fair value. Then I'm going to exclude stocks where Glassdoor's CEO approval rating is less than 68%. And then I'm also going to kick out stocks where the estimated fair value is either inconsistent or trending down in the long term. So after this, I'm going to end up with a portfolio of hopefully 30 high quality, consistently compounding stocks. I'm going to equal weight them, and then I'm going to buy them at M1 Finance. Ideally, never going to rebalance these. I'm never going to trim them, never going to sell anything, I guess until I need the money or whatever. But basically, I'm not going to disturb the portfolio. I'm also going to set a sub-industry limit of 10%. So I'm not going to buy more than more than 3 of any particular sub-industry. So now that we've got the rules behind us, let's jump over into the research platform, and I'll show you exactly how I'm going to do this. You don't have to have this, obviously, to do this. You just need to have some sort of data, some sort of methodology that you're using and following. And getting that data in kind of a consistent way if you're planning to do the index over time. But yeah, this is what I'm using, so this is what I'm going to share. So jumping over here to the platform, I'm going to go to indices, the top, and I'm going to select the S&P 500. I could also do, if I wanted to do small caps, for example, I could pull up the small cap index. So that would be this here. I might do another index on small caps. I think that would be fun. I also might do one on the NASDAQ. Anyways, let me know in the comment section if you guys like this kind of stuff. Maybe I'll do more of this in the future, but I'm going to use the S&P 500, and then I'm going to go here to quality rating, and I'm going to sort it top to bottom. So you can see I have 5 stars here. This first one, highest score is NVIDIA. And I'll show you how this is calculated, because this reflects kind of my underlying methodology, underlying philosophy, if you will, for what a quality stock is. So I've got it scored here by different metrics, and I've got basically 3 categories, which I think all high quality businesses should have some components of each one. Should have some growth, should have evidence of a wide economic moat, and then should have financial strength. So just some balance sheet items. So I won't dig into each and every one of these. If you do have access to the platform, if you want to know what these are, you can scroll over this little eye and it'll tell you more details. I think one of the keys to any high quality business is having top line revenue growth. I think that's essential. So in this case, NVIDIA has 1-year revenue growth of 71.6%, which is obviously outstanding. And then I compare it to both the sector and the overall universe that I'm covering, which is about 1,500 stocks. So the sector, technology, had an 8.3% average revenue growth over the last 1 year. NVIDIA beats that, obviously, soundly. The universe had 1-year revenue growth of 4.9%. NVIDIA also beat that. So it gets 2 out of 2 points for that particular metric. Then we go to 3-year revenue growth, which is the same thing. It's just measured over the course of 3 years. We have 5-year revenue growth and 10-year revenue growth. For owner's earnings, now this is my take on owner's earnings, which is Warren Buffett's calculation, what he believed to be the starting spot for fair value. I did a video on this, which I looked into the owner's earnings for Oracle. So if you're interested in seeing more about about owners' earnings and how to use it for valuation. I'll put a link to that in the description down below. So I want to see how they're growing that over time. Same logic. Is Nvidia or whatever stock growing faster than the sector and the universe? Then finally, I've got growth consistency, which is measuring how frequently are they growing over any 12-month period. Ideally, I want to see businesses that are consistently growing year after year and not just having giant spurts of growth in one year and then shrinking the next. I think great quality businesses are consistent. So Nvidia, over the last 40 quarters or 120 total observations, they've grown their fundamentals 84% of the time, which is better than the sector and better than the universe. So they get actually a perfect score for growth, 18 out of 18. They also get a perfect score in moat. I use a lot of traditional metrics that quality investors like Buffett have used to measure whether a business has a competitive advantage or not. I use owners' earnings on invested capital, which is a custom metric, again, using these owners' earnings calculation. I also use gross profits, to assets, which Novi Marks, there was a 2012 research paper where he showed that this is an excellent metric for predicting outperformance. Gross margin, operating margin, return on equity, assets, invested capital, all of these have been used for a long time in assessing quality. Then I've got medians over the last 10 quarters for return on assets. So sometimes you'll get a business that had a really good return on assets in a particular year, but they have not sustained that over time. So I want to see both this year is good, as well as the median over the last 10 quarters, and also the median over the last 10 years. Again, are they better than the sector and better than their universe? Nvidia's case, they're better across all metrics. The only thing they get a ding on, 6 out of 8 points for financial strength. I have interest coverage ratio, which measures how many times could they cover their interest expense with their earnings. Shareholder yield is 0.9. This combines dividend yield and buybacks divided by the current market cap. So shareholder yield is kind of like a valuation metric. Nvidia is a little more of an expensive stock relative to its peers. So it has a 0.9% shareholder yield. The peers or the sector have 1.7, and then the investable universe is 3.1. So they get 0 out of 2 for that one. But for the debt metrics like debt to equity, interest coverage, they get 2 out of 2 for both. And then preferred stock outstanding. This is the most expensive form of capital. So if a business doesn't have any preferred stock outstanding, that's a good sign. Basically, if they have 0, then they get 2 out of 2 points. Most companies don't, so it's just a quick check that I like to make. So that comprises my my scoring system. So it's a total of 52 points total that you can get. Looks like Nvidia got 50 out of 52, which is good for the number one overall. The other thing I want to look at is estimated fair value. So let's use a different stock for this one. Let's use Microsoft. So I'll jump in here to Microsoft and look at their valuation estimate. So you can read a little bit for how this is calculated. So essentially, this is using different metrics like the owner's earnings calculation, revenue, gross profit, operating income, net income, free cash flow, cash from operations, and dividend paid. It's using all of those as an independent variable in a regression formula. And then it's estimating based on the historical pricing. So I'm using the last 28 quarters worth of data. How has the market historically priced the company relative to those individual metrics? And then we're just running a regression. That's it. That sounds fancy and impressive. I did this in college. This was not like rocket science or anything. So anyone with any kind of statistical background could do this pretty easily. But I think it's an overall useful way to just kind of estimate what the range of fair value is. It's not overly precise. I don't use it to the dollar or anything like that. But what I do want to see is that generally I'm buying stocks that aren't just egregiously overpriced based on their historical ratios. So this overall median just simply takes all of these models, all the outputs, takes the median of them. So if you've got a couple that are that are outliers. Trying to see if I can find one. They all look pretty consistent for Microsoft because it's a pretty consistent business, but in some cases you'll have kind of a wild outlier that's, saying it's 50% overvalued, and another one says it's 50% undervalued. Kind of want to kick those out and just use the median. So this suggests Microsoft is currently trading at a 7% discount to its estimated fair value. Then I've got a ranking, kind of like the really expensive market cap would be roughly 5 trillion. Really good buy market cap would be 3 trillion. It's currently trading at 3.6 trillion. Estimated fair value is 3.88 trillion. So pretty close. Definitely call this about fairly valued. So that's what I'm going to use for the value. I like that this is just statistics. It's just math. So it's not my assessment of what the company is worth necessarily. So it keeps it consistent over time. So I'm going to come back here to the S&P 500, just this dashboard, and I'm going to click on this Export to CSV button. I'm going to open this in Excel. Okay, so once it goes over to Excel, this is what we've got. We've got the ticker for each company, sector, industry, sub-industry, and then we've got all the different metrics, the market cap, current market cap, fair value estimate, the percentage undervalued that it suggests that it is, the quality rating, return on invested capital, shareholder yield, and gross profit to assets, all of those there. I'm going to do a filter where I'm just going to kick out everything that's not a 5-star rating. So I only want the 5-star quality. And when I do that, I end up with this list. So we're going to do quality rating is 5. Then I'm going to sort it by estimated fair value, top to bottom. So this number one scoring stock, is Align Technology. So that one scores really well on fair value. Just a newsflash, I don't think it's actually 111% undervalued. I don't think the market gets things wrong, at least that wrong, very often. So chances are there's kind of more behind the scenes, and I'll show you how to kind of sniff that out here, or how at least I'm going to try to sniff that out. So here we go. We've got our high quality 5-star companies based on my 52-point scoring system, and then we're ranking them by potential best value to worst value. So we've got a starting spot. Next, we're going to do the Glassdoor ratings. And this is what we're going to use to estimate management quality. I think this is a really good way to do it. I can't think of another quantitative way that makes assessing management easier. I'm going to go to our friends at Google, and what I'm going to do is I'm just going to start with the number one stock on the list, which is Align Technology, and I'm going to do Glassdoor reviews. Click enter, and then we're going to click on this pros and cons of working at Align Technology. Click on that. So what this basically does is it takes reviews from employees, and the employees will recommend how likely they are to recommend this employer to their friends. And then they're also going to say whether they approve or disapprove of the CEO. So Joe Hagan's the current CEO of Align Technologies. 60% of the employees approve of Mr. Hogan. So I'm going to go back to my Excel spreadsheet, and I'm going to enter a new row. I'm going to call this Glassdoor ratings. I'm going to just basically 60% for Align. I'm going to do the same thing for Market Access, Dexcom, Gartner, etc., etc. It doesn't take very long, a couple seconds each stock, but I ranked them all, the Glassdoor rating. Now what I'm going to do is I'm going to exclude all the companies that have a 68% score or less. So Align Technology scores 60%. The basic philosophy of this is just that employees know the inner workings of the business best. So if they think poorly of the CEO, then that very likely reflects a poor CEO. It may or may not. In some industries, it's different, like retail might be a little bit lower scores on average. I don't have a great way of sorting that out. So I'm just kind of using this crude metric, but it is clear if you look at the list that some of these are pretty obviously low. Like for example, where is it at? Public Storage. The CEO got a 32% approval rating. Any company that I'm going to invest in for a long period of time, I want them to have good, competent management. So I'm going to sort out anything less than 68. Once we filter all of the 68s out, so I'll say greater than 0.68, and now we're going to end up with this list. I'm going to do one final step before we end up with our list of 30 stocks, and that is I'm going to check and see if the fair value for some of these companies is increasing or decreasing. I want to make sure that the companies that I'm investing in are consistently increasing their fair value over time. You don't want to buy a company that looks like it's a tremendously good value, but the value is eroding over the long term. We want time on our side. Buffett said, time is the friend of the wonderful business and the enemy of the bad business. So if you buy a bad business, it's destroying fair value over time. It doesn't matter what kind of deal you got it at. If you hold it long enough, it's going to destroy value and you're not going to make any money on it. So we want the businesses to be building value. So I'm going to reference my list here, and I'm just going to start here at the top. So Market Access Holdings, MKTX. And I'm going to go up here to the top right, and I'm going to do MKTX, which is the ticker symbol, Market Access Holdings. Click on that, and it's going to pull up the stock. So you can see it's a quality rating of 5 stars. We're showing it's trading at a 48% discount to fair value. It has good management. So this is kind of the last step. However, take a look at this black line, which is the estimated fair value of the stock. It looks like it peaked back in COVID 2020, Q4, 2021, Q1. And then ever since then, you see it's been falling over time. So I don't really want to buy something like this. It looks to me like something happened in 2020 and market access, whatever they do, we can read here what they do. So they're an electronic trading platform for institutional investors and broker dealers. Okay, so they're a trading technology company. Maybe there's less bond issuance or something happened to them. I don't exactly know what, but whatever it is, it looks like it's eroding fair value. Looks like their fundamentals are declining. So I'm going to cross this one off the list. So go back here to Excel, and I'm going to add a new column, falling fair value, and I'm going to give market access an X. The next stock on the list is Dexcom. So I'm going to go up here, type in Dexcom in the search bar. There it is. Pull it in. And again, we see the same thing. We see it was pretty consistently increasing fair value, but then looks like over the last 12 months, something's happened and it's kind of reached an inflection point. You could argue that this one's okay. You do have consistent growth over time. This does get subjective, so maybe this isn't ideal for an index. But I'm gonna go ahead and cross this one off. Next on the list, and I won't take you through all of these, but I just want you to kind of see what I'm doing here, what I'm looking at. We go to Gartner, so it's IT is the ticker. There we go. Pull it up, and we're going to scroll down to the fair value estimate. And this one is quite interesting. You can see that the red line, which reflects the market cap, has absolutely fallen off a cliff. So the market is sniffing out something that it thinks it knows about the business. But if we look at the estimated fair value, which does use the kind of underlying fundamentals, that's still going up. And it looks like it's kind of consistently gone up in most years. So I'm going to say this one's fine. We're going to leave that one in the portfolio. Next, we have Adobe. I'm going to pull that one up. This one looks, again, like in 2021, 2020, 2021, whatever around there, it peaked, and ever since then it's kind of been flatlining to down. So I want to see a company build intrinsic value. So I know Adobe is a great business, so they have been, but I'm gonna kick that one out. Next on the list is Zoetis, which I believe is an animal pharmaceutical. Yep, animal health medicines, vaccines, products and services. That one has been, again, sloping down in recent months. So in these cases, they're showing up as really good values, but the reason they're quote unquote good values is that the market is spooked by falling fundamentals. So I think we should, at least me, I'm going to avoid these as well. Let's just do 2 more here. So I'm going to do Verisk, type that in, and I'm going to come down here. Here's one. Again, we see some inconsistencies. You could argue this should be kicked out, but I think in recent years it's moving higher. So I'm going to leave that one in. Last one let's take a look at is Motorola Solutions. Let's scroll down. This one you see, this is really kind of what I like to see. It's just almost every single year you see an uptick in estimated fair value, which I think is a good sign of a great, consistently compounding business. So I'm going to go down the list and just put an X. Anytime I see falling fair value, I put an X. So we're going to kick out the ones we just discussed, as well as MSCI gets kicked out, ResMed, Qualcomm, Regeneron Pharmaceuticals, and that's it. I'm going to now sort them, kick out the X's, and now what we're left with is 30 stocks, I believe. Let's make sure. And so now we finally have our list. This would be the initial Coffee Can 30 consistent compounder index constituents. These will change over time as we have different ratings. The companies will change, the fundamentals will change over time. So this is the first one. I'm actually quite curious to see how this index does over time. I hope it does well, and I hope to be able to update you guys on how it does over the years. But yeah, here it is. So we have the 30 stocks are Gartner IT, Verisk Analytics, Motorola Solutions, Fortinet, Cintas, Cadence Design, ServiceNow, S&P Global, Microsoft, EOG Resources, Garmin, Stryker, Costco, MasterCard, NVIDIA, F5 Networks, WW Grainger, Broadridge Financial, Fastenal, Darden, Rollins, Train Technologies, Allegion, Eaton, DR Horton, Amphenol, Eli Lilly and Company, Arista Networks, Monster Beverage, and Parker Hannifin. And as a final check, we want to make sure that this sub-industry, we don't have more than 3. And I did a little count if here formula, and no, we do not have any that have more than 3. Communications, equipment, and pharmaceuticals both have 3, but that's fine. We can have 3, just not 4. So that's it. My plan is to buy those 30 stocks equal weighted at M1 Finance and then just let them go. We'll see how it progresses. See if we can manage to outperform the S&P 500 index, which I would say would be my goal for this portfolio. I'd be really happy if we could do that. I'd also like to see this portfolio hold up better than the S&P 500 in down markets. That would also be great, but we never know. We don't know if these indices that we make are going to beat the market or not, or achieve our goals or not. If you're interested in the Coffee Can research platform that I made and that I use for these for this index today, you can check out the link in the description down below. I'd love to have you as a subscriber. I think it's hopefully a fantastic platform that can help you quickly determine whether a business is high quality and is trading at a reasonable value. It's not the end of a research process, probably just the start of one, but I'm really excited about it. I do use it for my own investment process, and I'm really excited to share it with all of you. So check out the link in the description down below, and I will see you in the next video.